Hello, traders. So I want to take a moment to briefly discuss what are called synthetic positions. So the easiest way for me to share these with you is to come into optionstrat, which again, great program for visualizing these sorts of things. I can come in specifically and I can build a long synthetic position. Now, the thing I want you to note about this synthetic position is specifically take a look at the description down below here. A long synthetic position is a strategy that simulates long stock. So it has the same profile. When the stock goes up, this increases in value. When the stock goes down, it decreases in value. But you can essentially put this trade on at virtually no cost. So it's an alternative to owning stock, allowing you to have the leverage without the upfront cost of actually buying the stock. So this consists of an at the money put. You're going to sell an at the money put and you're going to buy a long call. Because you have a short put, there will be monies that your broker is going to tie up for having that short put on there. So there's going to be some buying power that's going to be tied up in this process. But you don't have to actually outlay the cash to buy the stock. Keep in mind, of course, that every option represents 100 shares of stock. And also keep in mind that because you are short a put, you can get assigned the stock. So you need to be cognizant of that. So that's a long synthetic. Now you can do the same thing, creating a short synthetic. Let me go back to that description here, but this is what a short synthetic would look like. And if I come back here to the build and just highlight over short synthetic, we can see that it's got the same profile of short stock. In many cases, you can't short stock, like in an IRA, you can't short stock, but you can get to the same position by buying a put and selling a call, the exact opposite of the previous position. So this is a bearish position. And also keep in mind, because you sold that call, you do have the potential risk of being assigned short shares of a stock. So if you are doing this in an IRA or something along those lines, you can't hold short shares. So if you do in fact get assigned, your broker is going to call you and say, hey, Joe, you've got short shares now in whatever stock it was, and you can't have short shares. So you're going to need to address that by covering those short shares and most likely just simply reselling another short call if you want to maintain this position. So this is how people might use synthetic positions. Now, the one time you wouldn't probably want to use a synthetic position might be on a stock that you want to own for dividend purposes. So if a stock pays a dividend, you have to physically own that stock in order to receive the dividend. So this would really only be something to consider on, in my opinion, in non-dividend stocks or stocks where the dividend is so inconsequential that it really doesn't make any difference. So that's our quick coverage of synthetic positions.